If you're looking for high dividend stocks that withstand the test of time and pay you high yield passive income every single month, then this video is exactly where you need to be today. Today, we're going to be covering 3 types of dividend tiers and how each of these tiers fits into your portfolio. We'll discuss specific dividend stocks for passive income, and I'm going to cover each one individually, and then at the end, I'm going to share what it takes to get to $100,000 a year in dividends. Now, all of that is covered today, so stay tuned till the end. And as usual, I put timestamps down in the description so you can skip to your favorite parts and not be held as hostage today, because I know that's important to some people. Your time is valuable, so let's get started with why we need to consider dividend stocks, especially right now when you look at the stock market and where it's at and what's happening in the world. Volatility always comes back, no matter what. Markets get choppy, confidence fades, and nobody really knows what the next 12 months are going to look like. So what actually works in environments like this is owning businesses that pay you whether markets are up or down or doing whatever they're doing. Businesses that keep sending you cash regardless of headlines or short-term price moves is what we want in this portfolio. The best time to build dividend income isn't when everything feels safe and obvious. It's when quality dividend stocks get ignored, pushed down in price, and quietly start offering higher yields and better long-term upside. Now, historically, when volatility rises and momentum fades, cash-producing businesses start to matter again. And when dividend stocks are ignored, that's when income investors quietly lock in better yields at better prices. So let's break down the 3-tier system if your long-term goal is something like, let's say, $100,000 a year. Now, everybody's different, of course, and the amount doesn't really matter. You need these types of stocks working together regardless of what your goal is. So this isn't an idea that I just made up for this video or for YouTube. Now, variations of this exact structure are used by long-term investors, pension funds, endowments, and dividend-focused portfolio managers for one simple reason. No one single type of dividend stock works in every market environment. So tier 1 is high income. This tier generates cash flow immediately. These stocks pay higher yields and give you income you can use to reinvest right away. They provide flexibility and help fund the rest of the portfolio. Tier 2 is more balanced stability, and this is the foundation, we'll say. These companies have long dividend growth histories and strong business models. They don't grow the fastest, but they do keep income steady and protect the portfolio during volatility. And then we have tier 3. This tier focuses on compounding. These stocks yield very little today, but grow dividends consistently over time, turning into meaningful income producers years down the road. So this isn't the only way to do this, and it won't be right for everyone. Different goals, timelines, and tax situations change what makes sense. Think of this as a framework and not a prescription, and if you're working with real money, getting input from a qualified professional is a smart move here, okay? So let's get into the actual businesses and where they fit into the tiers. Let's start with tier 1, high income now. The first company we're going to talk about is Verizon, ticker VZ, with a yield of 6.1%. Now, Verizon is a textbook example of why dividend investors should not fear price weakness. The stock struggled largely due to debt concerns and slower wireless growth headlines, but the dividend never moved. As a result, the yield climbed. Nothing about the core business broke here. There are only a few companies that run wireless in the US, and Verizon is one of them. Building a nationwide network costs insane amounts of money, and the government controls the spectrum. So no new company is coming in and replacing them, at least not anytime soon. Verizon runs the biggest wireless network in the country with over 140 million connections. People don't cancel their phone plans when the economy slows down. Remote work, streaming, business data, 5G, all of that keeps growing whether markets are happy or not. Now on the money side, Verizon generates enough cash to cover the dividend and buybacks without stretching. The payout sits around 67%. Now this isn't a stock you buy and brag about at your next family dinner. It's a stock you own because it quietly sends you cash. Okay, last stock for this tier is Pfizer PFE with a yield of 6.7%. They're here for one reason, income today, and not because it's perfect. This is one of the largest pharmaceutical companies in the world, selling drugs across oncology, vaccines, immunology, and rare diseases. It has global distribution, regulatory moats, and products that healthcare systems rely on regardless of the economy. The stock is down and the yield is high because Pfizer came off an abnormally high COVID earnings peak. Revenue normalized fast, earnings dropped hard, and sentiment collapsed. That pushed the stock lower and lifted the dividend yield to around 6 to 7%. Now let's be honest about the risk here. Pfizer's payout ratio is currently over 100%, which means earnings don't fully cover the dividend at this point in time. That matters. This is not a set and forget dividend. But that number is distorted by temporarily weak earnings and large non-cash charges. The business still is generating cash, and management has chosen to hold the dividend steady while the company restructures and refocuses on its drug pipeline. That means dividend growth will likely be slow, and possibly, if execution fails, that could drop the dividend. It's possible, but we'll see what happens. Now that's the trade-off we have here. But this is also why the stock is cheap. You're getting paid well while Pfizer works through a transition period, not because the business disappeared. This is exactly what Tier 1 is for. High income now, higher scrutiny, and clear limits. All right, let's move to Tier 2, which is balanced stability. These stocks anchor the portfolio. It exists to stabilize everything around it. First up is Chevron CVX with a current yield of 4.1. Chevron is another great example of what income investors often misunderstand. The stock isn't supposed to be exciting. It's supposed to be durable. Chevron has paid dividends for decades and has increased them for more than 35 years. The yield moves around depending on oil prices, but the company's priority is clear: protect the dividend. The business is built for that. Chevron isn't just an oil producer, it's fully integrated. They produce oil and gas, transport it, refine it, sell finished products, and that matters because when oil prices fall, parts of the business get hit, but other parts benefit. And so it smooths out the cash flow. And Chevron runs one of the strongest balance sheets in the energy sector. Debt is conservative, costs are low, and they can stay profitable at oil prices that would crush weaker competitors. Now, when oil prices surged, Chevron didn't blow the money. They paid down debt, raised the dividend, and bought back shares. When oil prices pull back, they don't panic. The business still throws off cash. Now, just for a quick reality check, energy stocks do look risky because prices swing, not because these companies are fragile. Chevron isn't a growth story. It's not trying to double overnight. It's an income stock designed to survive bad cycles, capitalize on good ones, and pay shareholders through all of it. Next up, ABBV Inc., ABBV, with a yield of 3.1%. This is a large pharmaceutical company that develops and sells prescription medicines for chronic conditions like autoimmune diseases, cancer, and neurological disorders. For years, everyone fixated on one thing: Humira losing patent protection. The fear was that once Humira declined, the business would fall apart. That actually never happened. ABBV used the cash from Humira to build the next phase of the company. New drugs stepped in faster than expected, and they are still growing. The dividend didn't pause, it actually kept increasing. And that tells you what kind of company this is. Demand for their products doesn't depend on the economy. Patients don't stop treatment during recessions, and that makes cash flow much more stable than most people would realize. Financially, ABBV generates enough cash to support the dividend, invest in new drugs, pay down debt, and buy back shares. Now, management has been very clear that protecting the dividend is a top priority. Now, this isn't a biotech lottery. It's just another cash-producing healthcare business designed to pay shareholders while it keeps operating quietly in the background. Next, we have Johnson & Johnson, JNJ, with a yield of 2.3%. And they make medicines, medical devices, and healthcare products used in hospitals and clinics every day. Think cancer treatments, surgical tools, orthopedic implants, and essential pharmaceuticals. Now, this isn't trend-driven stuff. It's healthcare infrastructure. People don't stop needing surgeries or medicine because the market is down. Johnson & Johnson has raised its dividend for over 60 years straight, and that alone tells you what kind of business this is. Wars, recession, inflation, tech bubbles, none of that really stopped the dividend from going up. Now, the company generates massive, steady cash flow and keeps a conservative balance sheet. That cash funds research, acquisitions, buybacks, and of course, the dividend. Now, management has always treated the dividend as non-negotiable. Even when headlines hit around lawsuits or spin-offs, the underlying business keeps working. Hospitals still buy equipment, doctors still prescribe drugs, cash keeps coming in. Johnson & Johnson isn't a stock you buy to flex gains. It's a stock you own because it quietly compounds and pays you year after year without drama. Okay, so the last one for Tier 2 is ExxonMobil, XOM, with a yield of 3%. At its core, Exxon produces oil and natural gas, refines it, and sells finished energy products around the world. And that full setup matters. When oil prices swing, parts of the business get hit, but other parts benefit. It keeps cash flow steady, and that is what we need here. So this isn't some high-risk shale operator living quarter to quarter. Exxon runs massive long-life projects that can operate profitably when oil prices are lower. When energy prices are high, Exxon uses the cash to pay down debt, invest in future production, and buy back shares. When prices fall, the business doesn't fall apart. It keeps generating enough cash to get through to the next cycle. Energy stocks look scary because prices move fast, not because companies are fragile. Exxon isn't about chasing oil spikes, it's about owning a cash-producing energy giant that can handle bad years and you can capitalize on the good ones. Okay, so now let's move to tier 3, and this is where tomorrow's income is built. Now first up is Microsoft. MFST with a yield of 0.9. Now, if you watched my last video on CRM, you would know that I spoke a lot about Microsoft and software stocks in general. They are getting crushed recently. But that's exactly why it's worth talking about right now, because over the last couple of years, Microsoft swung hard with the rest of tech. Rising interest rates hit growth stocks, AI hype pulled it up, and then valuation worries pulled it back. The stock moved around a lot, even though the business itself barely changed. At its core, Microsoft sells software and cloud services that businesses depend on to function. Think Windows, Office, Azure, Teams, security tools. Now, these aren't optional. Once a company is built on Microsoft's ecosystem, switching is painful and expensive, and that's why revenue is so recurring. Microsoft generates massive cash flow. Free cash flow runs in the tens of billions per year, easily covering the dividend. The payout ratio sits around 20%, which is very conservative. That means the dividend is extremely safe and still has plenty of room to grow. So when the stock drops on macro fears or valuation resets, nothing fundamental breaks here. Cash still comes in, customers still pay, and contracts still renew. The volatility we see right now is market emotion and not all business risk. This isn't a stock we own for income today. It's a stock we own because it compounds cash, grows the dividend every year, and turns temporary fear into long-term income growth. Next, let's talk about a Canadian stock, Enbridge, ticker ENB on the TSX with a yield of 5.8%. They own pipelines, storage, and energy infrastructure that transport oil, natural gas, and liquids across North America. Now, these are long-term regulated contracts. Customers pay to use the pipes whether commodity prices are high or low. And because of that setup, Enbridge's cash flow is very predictable. Around 95% of earnings come from regulated or contracted assets, and this isn't a boom and bust business, okay? Now, the income side, let's look at that. They've raised the dividend for nearly 30 years straight. Through oil crashes, recessions, rate hikes, and every energy panic cycle, the dividend kept getting paid. The recent volatility comes mostly from higher interest rates and headline noise around debt and projects, not from a collapse in cash generation. The pipes are still full, customers are still paying, contracts are still locked in. Enbridge isn't exciting, it's not supposed to be. It's a toll road on North American energy, designed to send you cash while everyone else argues about the price charts. So the last one on the list is Alphabet. Current yield is 0.2%. Alphabet is sitting near all-time highs, and that's important context before we jump into the wrong conclusions. This isn't a turnaround story. It's a dominant company being repriced higher because the business keeps delivering. It's a $4 trillion company pulling in roughly $385 billion in annual revenue with operating margins north of 30%. Free cash flow margins are close to 20%, which means an enormous amount of real cash drops to the bottom line every year. Now, here's where it becomes relevant for dividend investors. They do pay a dividend now. The yield is small at around 0.2%, and the payout ratio is roughly 10%. That's a key number. They're barely touching their cash flow to fund the dividend. And at the same time, Alphabet holds nearly $100 billion in cash, has negative net debt, and continues to buy back tens of billions of shares annually. This is one of the strongest balance sheets in the entire market. So why not include this on a dividend list? This is exactly how long-term dividend compounders start. Small dividends, extremely low payout ratio, massive excess cash, tons of room to grow payouts over time without stress. Yes, the stock has been volatile, even near highs, and that's because expectations are high, not because the business is fragile. Every AI headline, every earnings report, every regulatory story moves the stock short term, but the fundamentals barely budge. Search is dominant, YouTube continues to scale, cloud is growing double digits, cash keeps piling up. This isn't a stock you buy for income today. It's a stock you buy because future income is almost inevitable, given the cash generation it has. Alphabet belongs on a dividend list not because the yield is high, but because the dividend is just getting started and it's backed by one of the strongest cash engines in the world. Now that you've seen the 3 tiers and the types of stocks that make up each one, the last piece is the math. Because once the structure is in place, this stops being theory and starts being numbers. Dividend income is simple. It's not magic and it's not passive in the sense of doing nothing. It's passive because the income comes from ownership, not your time. The money shows up whether you work that week or not. Now, here's the basic formula. Your annual income equals how much you have invested multiplied by your average yield. Very simple stuff here. If your portfolio averages a 5% yield, every 100,000 invested generates 5,000 a year in revenue. That means to reach 100,000 in annual dividend income, you're looking at roughly $2 million invested. At a 4% yield, the number is higher, around $2.5 million. At a 6% yield, it drops to $1.7 million. That's why yield matters, but not by itself. Higher yield lowers the capital required, but usually grows slower. Lower yield requires more capital, but compounds faster over time. When you blend all 3 tiers together, a realistic long-term portfolio often lands somewhere around 4.5% to 5.5% in that range. And the most important part is this: you don't need to start with millions. Dividend income compounds because the cash gets reinvested. Those dividends buy more shares, which produce more dividends, which buy even more shares. And over time, the income starts to accelerate. That's the framework. There's no secret stock, there's no shortcut, and there is no moment where this suddenly turns into gambling. It's ownership, cash flow, and time doing the work. The goal isn't to rush to $100,000 a year. The goal is to build something that keeps paying you whether markets are up, down, or sideways. If you get anything from this, it's that dividend income isn't about excitement. It's about control. Control over your time, your cash flow, and your future. Start where you are, build it gradually, let the math do the heavy lifting. And over time, the income takes care of itself. That's how this actually works. Anyway, take care. Let me know in the comments, what tier are you focusing on right now? If you like these types of videos, please don't forget to subscribe, and we'll see you in the next one.